keep $150,000 tax-free in retirement legally. Before we start, you may see a few ads. Thank you for letting them play, so I can keep bringing you free, actionable advice. Now let's continue. Just imagine for a moment that you have worked for 30 to 40 years to build a nest egg that finally hits that 7-figure mark, only to realize that the Internal Revenue Service is effectively your largest silent partner. For many high-net-worth individuals and business owners, the fear is not that they will run out of money, but that a massive portion of their wealth will be siphoned off by shifting tax brackets and the dreaded required minimum distributions. If you are sitting on a portfolio of $1 million or $2 million, or even more, you could easily see 30 to 40% of that wealth vanish into federal and state coffers if you do not have a proactive distribution strategy. Most people are operating on outdated advice from 10 years ago, but the landscape has changed significantly with new laws that have altered the way we look at standard deductions and asset location. The problem we are facing right now is a phenomenon known as the tax ticking time bomb. If you have been diligently funding your traditional 401k or your IRA, you have essentially been deferring a tax bill that is growing larger every single year. The government is currently offering us a window of opportunity with historically low tax rates, but those are not guaranteed to stay forever. In fact, recent adjustments to the tax code, including the One Big, Beautiful Bill provisions, have introduced new nuances like the senior deduction and higher standard deductions that most people are completely overlooking. For example, did you know that for a married couple filing jointly, the standard deduction has climbed to over $32,000? Combine that with a new $6,000 per person senior deduction for those over 65, and you are looking at a massive chunk of income that the IRS cannot even touch before you even start looking at specialized strategies. The core of our $150,000 tax-free blueprint relies on a multi-layered approach to capital allocation and liquidity management. We are not just looking for one big loophole, because those rarely exist for the long term. Instead, we are looking at how to stack various tax-free buckets so they work in harmony. The first pillar of this strategy is the 0% capital gains bracket. For many investors, this is the single most underutilized tool in the entire tax code. In the current environment, a married couple can have a taxable income of up to $98,900 and still qualify for a 0% long-term capital gains rate. This means you could potentially sell highly appreciated stock or real estate assets and pay absolutely zero in federal taxes on those gains, provided your other income stays within that threshold. However, the real magic happens when you layer this with your standard and senior deductions. If you are over 65 and married, your combined standard and senior deductions could take your effective tax-free baseline to over $44,000. When you add that $44,000 to the nearly $99,000 of the 0% capital gains threshold, you are suddenly looking at roughly $143,000 in potential cash flow that is essentially invisible to the federal government. This is not about hiding money. It is about the intelligent application of current law to maximize your capital efficiency. The second pillar involves the strategic use of Qualified Charitable Distributions, or QCDs. If you are over the age of 70 and a half, you have a superpower that younger investors do not. You can transfer up to $115,000 per year directly from your IRA to a qualified charity. This is a game changer for high-income earners because it satisfies your required minimum distributions without adding a single penny to your adjusted gross income. This is critical because your adjusted gross income is the number that determines whether your Social Security is taxed or if you have to pay higher Medicare premiums through the income-related monthly adjustment amount. By using a QCD, you are essentially pruning your IRA, which reduces the size of future taxable distributions and keeps your overall tax profile lean. Now let's talk about the institutional strategy of asset location versus asset allocation. Most people focus on what they own, but the wealthy focus on where they own it. To reach that $150,000 tax-free target, you need to ensure your high growth and high dividend assets are situated in the right buckets. For example, high-yield bonds or real estate investment trusts, which generate ordinary income, should ideally live inside your tax-deferred accounts like a 401k or a traditional IRA. Conversely, your growth stocks that you plan to hold for decades should be in your taxable brokerage accounts to take advantage of those long-term capital gains rates we discussed. A common objection I hear is, what about the money I already have in my 401k that I want to get out? This is where the Roth conversion ladder comes into play. You have to be careful here because a conversion is a taxable event, but if you do it strategically during lower income years, you can move money from a forever taxed bucket to a never taxed bucket. Think of it like paying a small toll today to avoid a massive bridge fee tomorrow. If you have a year where your business has a loss or you have high medical deductions, that is the perfect time to accelerate your Roth conversions. You are essentially buying future tax freedom at a discount. For the business owners watching this, the landscape for catch-up contributions has also shifted. If you are over 50 and earning more than $150,000 in wages, the law now requires your catch-up contributions to be made on a Roth basis. While some see this as a negative, it is actually a forced benefit for high earners because it ensures that those extra dollars and all their future growth will never be taxed again. When you combine this with a health savings account, which is the only triple tax advantaged account in existence, you are building a fortress of tax-free liquidity. For a family, the HSA contribution limits have risen to over $8,000, and starting recently, even more health plans have become HSA compatible. Let's look at a concrete example of how this $150,000 blueprint works in practice for a retired couple. Let's say they take $45,000 as a distribution from their traditional IRA, which is completely offset by their standard and senior deductions. Then they harvest $100,000 in long-term capital gains from their brokerage account, which falls under the 0% capital gains rate because their taxable income is essentially zero. Finally, they take $5,000 from their HSA to cover medical expenses and maybe another $10,000 from a Roth IRA for travel. You have just generated $160,000 in spendable cash, and your federal tax bill is effectively zero. This level of planning requires you to act like a chief financial officer of your own household. You cannot wait until April to think about these things, because by then the window for the year has closed. You need to be looking at your total income profile in November and December to see if you have room to harvest gains, or if you need to make a last-minute charitable contribution to stay in a lower bracket. The goal is to avoid the tax cliff where one extra dollar of income triggers a cascade of taxes on your Social Security and increases your Medicare costs. So, what are the immediate action steps you should take to secure your own tax-free blueprint? First, you need to perform a bucket audit. Look at your total net worth and categorize every dollar as taxable, tax deferred, or tax-free. Most people are heavily lopsided toward tax deferred, which is the most dangerous place to be if tax rates rise in the future. Second, calculate your projected required minimum distributions. If that number looks like it is going to push you into a higher bracket, start looking at Roth conversions or QCDs today. Do not wait until you are 73 and forced to take the money. Third, you should review your cost basis in your taxable accounts. If you have positions that have not grown much or are at a slight loss, use those to offset any gains you want to take. This is called tax loss harvesting, and it is a fundamental part of liquidity management. If you are still working, maximize your HSA and consider moving toward Roth contributions for your 401k, even if it means paying a bit more in tax today. The peace of mind that comes with knowing your future withdrawals are tax-free is worth the upfront cost. In summary, keeping $150,000 tax-free in retirement is not a fantasy, but it does require a departure from the status quo. You have to leverage the standard deduction and the senior deduction to create a tax-free floor. You must use the 0% capital gains bracket to liquidate appreciated assets without a penalty. You should utilize qualified charitable distributions to manage your RMDs and keep your adjusted gross income low. And finally, you must optimize your asset location so that you are not accidentally turning tax-free growth into taxable income. This is a complex area of law, and fresh videos on this subject are uploaded regularly to keep you informed of the latest IRS adjustments and wealth management strategies. If you found this blueprint helpful, please click the thumbs up button to give us a like as a thank you for this valuable content. We put a lot of research into these deep dives to ensure you have the authority and the knowledge to protect your hard-earned wealth. Please subscribe to the channel so as not to miss our next strategy session on high-level estate planning and asset protection. I would love to hear from you in the comments, so please share one idea from this video that you plan to discuss with your CPA or ask any questions and concerns you might have about your specific situation. As a final reminder, I am not your financial advisor, and this video is for educational purposes only. Tax laws are subject to change and vary by state, so please seek professional advice from a qualified fiduciary or tax expert before implementing any of these strategies. Your retirement security is too important to leave to chance or outdated information. Take control of your tax future today and start building your own tax-free legacy.